Hello, everyone. Welcome to Now, Next, Later for Monday, March 2nd. We're excited to have Eric Lapin back co-hosting for the second month with us. We'll jump right into our guest in a moment, but we wanted to thank Roku, our sponsor for today's show. Roku launched a new website today, so if you are curious about what the vision and the brand and the capability of Roku, check out Roku.com, book a demo, and see how their agentic platform can be an all-in-one solution for all channels and all consumer data across your marketing, sales, lifetime customer value, which we talk a lot about on Now Next Later. So check out Roku.com and book a demo today. And with that, we'd like to welcome in Mike Manning. Mike, thanks for joining us on Now Next Later. Eric, Sasha, and I have been really looking forward to your blockchain expertise, your lending expertise, and really helping financial services navigate emerging technology. We get a lot of questions in this space. So I'll kick us off, Mike, and we're really excited to use this time to deep dive some of the practical implications that blockchain and tokenization and data integrity have for lending holistically across the board. And so maybe that's where we should start. How do we think about blockchain infrastructure, blockchain tokenization from a financial institution perspective? Banks, and we often talk about non-banks, have now become independent mortgage bankers. How should these two institutions be thinking about engaging with what can sometimes be like an intimidating infrastructure play for a lot of people in our industry? So help us just start off with a high-level deconstruction of blockchain infrastructure in banks and in financial services companies.
Well, sure. So you may have introduced me ahead of time, but I'm head of institutional finance for Ava Labs, which is affiliated with the Avalanche blockchain. I've been in the space for about, I guess, 10 or more years. Before this, I was head of blockchain and digital assets for Amazon. So I was looking at the world through a large corporate entities lens, which was very different from the way I got into this space, which was through more capital markets use cases. So I founded my own company in the ABS space that led me into Provenance and Figure, where they were issuing HELOCs on chain and looking at securitizations there, and then to Symbiont, which was a layer one protocol, again, very focused on capital markets applications. So my background spans startups to multinationals, capital markets to corporates to central banks. But to return to your specific question of what does tokenization look like within a bank and what are banks doing with tokenization, I think that I see there as being three distinct use cases, and they each have different implications. So those are crypto custody, interestingly, stablecoin payments, and then traditional assets or RWAs, real world assets. Just as a quick aside on that last one, I was using that term RWA, real world assets, in front of a guy who's more traditionally financed, and he said, well, what's an RWA? What do you mean? I explained what it is. He said, oh, you mean assets? And I said, I guess I do. Yeah. And it's sort of, I think, a bit indicative or indictment of the space that we actually append the term real world to differentiate it from what we are used to dealing with in this space, which is kind of self-referential. So it's one of those moments where I got caught up a little bit and had the insularity of the industry pointed out to me. But despite that, I think one of the first use cases that you really see activity in is crypto custody for banks. And this originally entered through private banking. In fact, I think BBVA's Swiss unit was the first regulated institution to offer crypto custody, and that emerged from client demand. And that's really what you see from banks is they will go where the client demand is. And certainly private banking and high net worth individuals saw a demand for custody. BBVA launched back in 2021, but BNY Mellon, which is the largest custodian in the world, has had a digital custody platform since I think October 2022, and now you're seeing that expand quite broadly. Now that's a really new and different and distinct use case, and it's much more focused around custody, and we can talk a little bit about the specifics about the digital asset world. The second use case is stablecoins. Now this is one that impinges much more directly on banks' core activities of moving money around, particularly cross-border movement of money. And so we're seeing a lot of energy in that space and a lot of competition from non-banks in that space, of course, banks are very much engaged in it. And with that, you're seeing, I think, a real push by banks for the use of tokenized deposits as an alternative to stable coins, both because they want to stay relevant, certainly, and they're worried about their deposit base. But whether or not you believe tokenized deposits are going to win or stable coins are going to win, I think there's a role for both. And the industry really ought to be welcoming this engagement by banks, because they are the natural bridge, not only between crypto and fiat, or stablecoin and fiat, but also to the broader world of banking services, which are going to layer around this. So I think that's a very exciting development. And then the final category is really what I think you're most interested in, your audience is interested in, which are mortgages and other RWAs. And there are some really exciting things that are happening there that we can talk about a little bit more. Obviously, Figure is doing a lot of origination of HELOCs on chain. Company that's building with FIS on our ecosystem, Intane, is doing another set of very interesting things with commercial real estate and other bank-related assets. But I would say, to be honest, that's still a fairly nascent category, and we're really in the early innings of that one. So what does it look like within a bank? I think you got to kind of break those up into crypto custody, more payment solutions, and then the one I'm probably most excited about is traditional assets coming on chain.
You mentioned, the different names of companies there. Are you seeing it from when you're, let's just say how would a risk executive evaluate this digital asset infrastructure that we've been talking about for years? Is it different types of institutions? I mean, you're institutional finance over there at Ava Labs. Are you seeing different parts of the world or different size of financial institutions and different needs of what is actually bringing that change about for this digital asset infrastructure? That's question part number one. And then, number two, how do you support the auditability and transparency for the regulated institutions? It's becoming more and more regulated. How are you seeing that handled?
Yeah, so on the first one, I think you see interest across the board. The larger banks certainly have the innovation groups and the budgets to stand up consistent efforts, and they've been in the space for quite a while. What I think you're seeing right now is very hopeful, is a broadening from the innovation group, which is often its own silo within an institution, out to the lines of business. And so that's beginning to penetrate deeper into the organization. You're also seeing a real desire or a real move towards launch products in market. And so a lot of them really are starting out now with custody solutions, because that's obviously a core banking service. And they really are going to market with that. They really are seeing demand from their clients. I think a lot of that is still more on the crypto side, and then increasingly on the stable coin side. I think, again, the other assets will come on top of that, but that's not happening as much right now. Smaller banks, I think, are looking for a way in. They don't necessarily have the same kind of technology budgets. And so I think it's important to be thinking about how we broaden this technology out. One of the promises of blockchain from the beginning has been democratization. And within the context of a banking network, we have seen a reverse document democratization over the last several years, as we've had more and more of a too big to fail kind of an incentive structure for banks to get bigger, partly, I think, pushed by the regulators who want to regulate. It's easier to regulate one or two large banks than a lot of little regional banks. I think we really need to bring the same spirit of democratization to the banking world as well. And one of the things that the digital technology can do, if done right, is hopefully allow for a broadening of the ability of regional banks to compete. But we've got to be intentional about that. That's why one of the applications that I think is relevant to this conversation is Intane, which, along with FIS, launched something recently called the Global Liquidity Exchange, which is a way of unlocking regional bank balance sheets and allowing them to recycle capital more efficiently. And so in simple terms, regional banks fund a lot of the economy. They do about 75% of CRE loans in the US. And yet those loans typically get issued in fairly non-portable form. They're in PDFs, they're in loan tapes. And these regional banks don't have capital market takeout desks. And so as a result, you tend to have a somewhat illiquid capital base. It can't be recycled. Intane is reaching into those data repositories at the banks and bringing those loans on chain, validating the data through AI agents and very specific asset class specific AI engines that are ensuring that the the integrity of the underlying data is valid. And then it will also be maintained because they're integrating with the servicing system, so they're managing the full life cycles. Once they've done that, they're able to digitally issue a loan on chain that is now more portable and composable and can be passed into loan warehouse vehicles where you can automate the concentration limits and the various calculation agent, paying agent functions there, move them forward, distribute them into securitization instruments or loan participation vehicles. So that I really think we want to be focused on helping all banks benefit from this technology, and that's sort of I think an important aspect of this, bringing democratization even to the regional bank layer. I didn't answer your question though, Eric, about how should a regulator think about this? What are the different risk profiles? So let me kind of come back and answer the question for real. So I think it's really important that blockchain infrastructure exists within the existing risk and control frameworks inside a bank. So that means you need to think not just about key management with respect to custody, but around the broader policies and controls that govern transaction approval. And so they need to have the same things they have in their existing world, and the same principles still apply. You want defense in depth. You want your role-based asset controls. You want to be very focused on what your hardware and encryption protocols are. You need fine-grained governance and permissioning, and you need to be thinking very carefully about separation of duties. So like in a traditional financial system, you might have a transaction proposer and a transaction approver. The same thing is going to apply in Web3 assets, but there are some different nuances. So for example, in a digital asset standpoint, you may want to make very clear that you've got different wallets for different control environments for wallets that control the minting and burning of an asset, wallets that control the whitelisting of an asset, wallets that control pause and freeze, which is important for traditional assets, and the biggest one of all, wallets that control the contract upgrade. I listened to an interesting presentation by GKA, which is a big custodian, who asked, what's the most dangerous private key in crypto? And the answer is it's not the private key that governs your access to your asset. It's the private key that governs control over the smart contract itself, because that affects everybody's holdings of the asset. So you really need.
So who's going to manage all this, right? I mean, that's the thing. If we're just talking housing, FHFA last year, made a notification that they want the GSEs to really spend a lot of time looking at this, from starting out with looking at it as asset verification and possibly, maybe. But, we don't have a lot of regulation in the United States around this today. I mean, how are you thinking? This is just a quick thought from you before we go to the next segment here. But how do you feel? How will wallets be regulated and governed by multi-custodial arrangements? Do you see it coming or being managed by one or two regulated custodians that are headquartered in the United States, for example, or is it going to have a global view with following something, say, like Dodd-Frank, or following the guidelines, or OCC or something, or CFTC, something like that? Where do you see this going?
That's a good question. And I'm going to give my quick answer, which will not be my deeply informed answer. But I think that in general, I think that the principles that we've got hundreds of years of regulatory history, and those have established certain principles. And I think in a lot of ways you can fit this new technology into the existing principles. Now, it's not always like completely easy. So we've spent a lot of time thinking about what the Howey Act means and what that means for what is a security and what isn't a security. That's a little bit more abstract. But I think around things like custody, none of those things that I mentioned, like role-based asset controls or separation of duties, those are not new concepts. Those are the same concepts implemented in a new technology strata. So I don't know that we need new regulate. You're going to need tweaks. Clearly, you're going to need certain specific implementation patterns that make sense. But I feel like ideally we should be able to utilize the existing regulations, at least in principle, and not require a whole new regulatory regime. But
yeah, Mike, I don't disagree with you. And I think Jeremy and I came both at one point from closing companies and worked very hard to get e-note adoption in the mortgage arena. And it's, arguably the most important asset in the mortgage transaction. And you are looking to digitize it and watch the custodial, management of it. And so that was managed and regulated just fine. And so I can understand, to your point, the idea of taking an existing framework, making some small tweaks because it does have some nuance to it, but I think that the underpinning is there. Spinning it a little bit more into the mortgage space, and admittedly, blockchain is not my area of expertise. So if I ask a question the wrong way, please do correct me. But I think what I understood from what you said earlier on is that the demand really came from private banking, and larger banks are the ones really experimenting in this space. Can you help differentiate for me and for the audience? Are they doing anything with mortgages yet? Are they experimenting? Are they trying to figure out how to right size it? And if so, what's happening there versus maybe how they're thinking about capital and operational resources for maybe other assets at this stage?
Yeah, and I would say that the first implementation, the first innovations I think happened below the GSIB level, like BBVA and their Swiss unit was private banking as opposed to the major GSIBs. But so I do say there's innovation happening across the board. With respect to mortgages in particular, we clearly have the HELOC example figure, where I think you've got arguably the first asset class that has been significantly disrupted by digitization. So the question is, and Eric and Jeremy, you kind of posited this question: is it going to jump the shark and jump the chasm and move in from HELOCs, which are first lien, into the primary mortgage? And I think there's no reason it shouldn't, but here's where I think the challenge is. It comes down to figuring out ways to recognize that I don't think we're going to have wholesale adoption of a single loan origination system that's digitally native from the get-go. And so key to the idealized vision of on-chain origination is that we really start with on-chain origination. We're not tokenizing an off-chain asset. We're originating it digitally. It's not, there is no other copy to dispute, and that is the source spring from which all benefits flow. The reality, though, is that I think we're going to be in a world where we're issuing on traditional LOSs for the foreseeable future. There's hundreds and thousands of different issuers that are out there. And so I think that's why we need to find ways to be onboarding in a reliable fashion assets that exist and were originated in a Web 2 kind of a framework where people were sending fiat money in for payment, because that's what consumers are going to want to do in the US and Europe, where you're not going to have like a landline cell phone moment like you might in Africa or in Asia, where you don't have reliable banking services. Here, we have credit cards, we have debit cards, we have bank accounts. We're going to continue to use them. They're just deeply embedded in our economic lives. So you need a way to make that switch from fiat to stablecoin, or from a loan document that I signed, maybe through DocuSign, not on a piece of paper, but into a digital version of that asset. And that's where, like I said, Intain's approach is different, and they're saying we're going to accept the world as it is, not as the world that it would ideally be, and we're going to find ways to bring that on chain. Now, to speak to your specific question, are banks looking at this? I think that what you're seeing right now is stuff that's easier to do is getting done now. So a lot of the tokenization is really, it's tokenization, it's not digital issuance. And so, to get somewhat pedantic about it, because tokenization gets used quite broadly, I think there is a difference between digitizing the wrapper, the cap table, the TA's record of holders, the whatever, the casino chip that moves around that carries my ownership interest, and the true life cycle event, the true asset itself. That's where the real value comes from, when you're reaching down into you're digitally issuing an asset, meaning you're representing the end-to-end life cycle of that asset, or as close to the point of origination as you can get. There might be this onboarding process, but you're executing as many of the asset lifecycle events as possible on chain. That's where you're getting a lot of the efficiencies, I believe, in terms of counterparty risk reduction, in terms of acceleration of capital velocity, of automation across the entire value chain. And that's hard to do. Of the 20-odd billion in real world assets right now, I think about 10 of that are treasury funds. And those are solidly in the tokenization camp. None of the underlying is digital. You've got a tokenized asset. Now that has value, particularly if you get into things like collateral mobility, where now you can post that back and forth very rapidly, where you can't with the analog asset. But to me, it's easier, and we can get to market quickly, which is great. But the real value is going to come when we reach down into the stack. And I think, Josh, to answer your question directly, it's being done by the fintechs who are leading this. I don't think it's being done by the banks right now.
Okay, thank you.
Yeah, Mike, it sounds like there are a variety of ways. You mentioned things like auditability and data integrity. So it should be the efficiencies we're looking at should be in due diligence. It should be in
Mhm.
loan delivery. You mentioned how regional banks actually probably would play really well in the warehouse line. They may already for a lot of IMBs. Where is the expansion or the innovation there? So we have these really practical kind of points of entry that are infrastructure kind of B2B plays. And then to your point, a lot of people want to monetize some sort of portfolio, commercial or residential assets. Let's monetize those. They're sitting somewhere. I actually want to hook into a much larger capital markets environment. So let's figure that out. So it sounds like there's just going to be a lot of these bridges happening. You work on Avalanche as the bridge. Can you talk about that? How does a platform like Avalanche thinking about like the operational aspects of this? Where do you start? What kind of roadmap does that look like? How should people be thinking about this work?
Yeah, well, I think it's probably helpful to give a little bit of a background on Avalanche itself, because I know some of these questions are around how do we talk about finality and auditability and transparency, and hanging over all of that, I think, is this sort of public-private chain debate. And what Avalanche offers, I think, it's my third L1, and after the first two, I said I'm not going to work for another L1 again, because they're very hard to get the infrastructure out, differentiate the infrastructure out in the world. I think Avalanche really does, and I think that the reason we've seen so much institutional adoption by Avalanche, and we very much are emerging as a preferred, if not the preferred, protocol for regulated financial institutions, is that we offer the best trade, the most elegant trade-off between the competing objectives that financial institutions confront when facing a decentralized environment, which is the tension between control and connection, or private and public. So job number one in finance is don't go to jail, right? You've got fiduciary responsibilities to your clients, you've got legal responsibilities to your regulators. There is a tremendous premium placed on privacy, on compliance, on safety. And that's what drove
do no harm.
Do no harm, right? Yeah, there's a Hippocratic oath,
yeah.
right? Do no harm. And so that's what drove the first wave of innovation into private chains, which deliver very effectively on those values. However, job number two in finance is don't miss out. Best execution. Capital markets or the financial industry is inherently a network. It's a networked entity. You need access to the broader pool of liquidity for assets, of innovation, access to developers, of customer reach. And so those are all signal characteristics of public permissionless chains. And so there's this just tension between the two. And what I think we're seeing happen after the thing that doomed the first wave of private permission chains was the siloing. They were great on control, they were bad on connection. Now we're seeing a rush back into connection. But honestly, I don't think we've gone very deep yet, and we haven't solved the problems in the first stage that drove us into permissioned chains. So I think Avalanche offers most protocols force you into a painful trade-off between the two, because that contradiction is just inherent in the space. Like there's just the nature of the beast. We offer a much less painful trade-off. So our goal is to deliver control without isolation and connection without compromise. And that's based on the unique protocol that underpins Avalanche design architecture, which is we're not a monolithic chain. We are an ecosystem of independent but natively interoperable EVM L1s. And so that ecosystem is anchored in C-chain, which you can think of as a faster, cheaper Ethereum. It's public and permissionless. And it's a vibrant ecosystem and economy in and of itself. But it also serves as a liquidity hub. And this is what I think is distinct and unique about Avalanche for the broader Avalanche ecosystem, which extends out to hundreds of purpose-built L1s alongside that. And those L1s are under the control of their operators. They control the node validator set. They control whether it's public or private. They control the coin. What's the economics of it? So it's basically your chain, your rules, but it's natively interoperable, meaning you can send money or messages or assets from any Avalanche L1 to any other Avalanche L1 without a third-party bridge. That makes it fast, single block settlement time. It makes it cheap, both technically and economically. It makes it safe because you don't have third-party bridge assumptions. It also then, coming around back to your question, it allows for a different design pattern. So you don't have to be public or private, you can be both. You can execute certain part of a complex financial transaction has multiple trust boundaries and multiple data sensitivity elements. So you might want to execute certain parts of your transaction flow in a private permissioned environment, but then settle out in stablecoin that's on the public permissionless environment. So you can operate in both simultaneously. And that I think is a really important that has important implications for how do you comply with your regulatory principles? How do you comply with KYC AML? Certain parts can live in one execution environment, others in another, and you get to kind of choose the methodology.
Yeah, I appreciate that explanation, Mike, because, a lot of times Eric and I are talking because it's banking Rails, and Rails has been used for so long to describe banking. We always kind of, Eric and I at least default to the train analogy. But Sasha, what Mike just made me think of was an airport, because you have these different hubs, you have different carriers in that airport who have different direct flights or connecting flights. Some are direct, some are connecting, and the airport itself has to kind of coordinate between all those different brands all the time and their routes. And Mike, you just gave me the impression, and I'm sorry to make it so simplistic, but it's something we all deal with every day. And this ability for different size institutions to deliver money and data will unlock a variety of investment opportunities for loan originators to go out and sell, for us to collect new pools of assets with different combinations and deliver those to different capital markets combinations at different times. And it'll be this combination for this type of thing and this combination for this type of thing. We don't have any of that today.
No, but all the while,
one-to-one
dynamic risk analysis on that, right? It'll be real time. Is that that's really kind of what you're saying. And Sasha's question too, and what Jeremy's saying here, it's all this can be real time, and use the airport analogy, different carriers, different gates, different arrivals, different departures. It all depends, but someone is going to control that, and that's the big question, right? We don't have a really strong governance for this in the United States right now. I mean, it's being talked about going into the 50 states, where my belief, this is something that actually should be federal. It's too much. It's going to be too costly. It's going to be too much for each company to try to figure out what each 50 states doing if they originate in all 50 states. And we don't have something like that today. I mean, you have OCC, you have FHA, you have SEC, but in the EU, where you now reside, Mike, right? I mean, you left the Bay Area, you went over to EU.
Yep.
I mean, you're working with Micah over there, right? Why don't you explain that for a minute over how it works in EU, and how do you see that possibly translating to the United States?
Yeah, so I'm actually in London, which, as we know which was part of the EU, but there was an event a year or two ago. But your point is absolutely well taken. And I called up the CEO of Securitize brokerage service this morning, because I saw the question about EU versus the US. And I better get smart on this, because I'm relatively new to the European realm. And there has been a very different approach. And I'm gonna and it's interesting to see the trade-off. So from a regulatory standpoint or supervisory standpoint, the EU is way ahead of the US. They've got two regimes, which is MiCA, which you mentioned, which is for crypto assets, and then the DLT pilot sandbox, which is for digital assets and securities, i.e. RWA. Both of those are regulated under ESMA, which is the kind of European equivalent of the SEC. And so there's the harmonization across the different entities within the Eurozone, which all sounds great, doesn't it? So you've got regulatory clarity, you've got harmonization. They ought to be blowing us out of the water. However, while Europe is ahead from a supervisory point of view, the US is way ahead from an adoption and products and market standpoint. And in some sense, this comes from this period of benign neglect, or I think the crypto industry would say not so benign neglect, this period of regulation by enforcement. But it had its virtues. And I think that even at the time, although it may have gone a bit further than we would have liked in the industry, the idea was, let's let 1,000 flowers bloom. Let's learn through case law or case history, and then design regulatory frameworks after that. What happened in Europe, by contrast, is everybody knew the regulation was going to come, because they knew they were Europeans and they regulate. That's what they do. And they knew that they were going to be bound by those regulations very clearly once they did come. And so everything kind of froze up for a long period of time while they waited for the regulations to be written. Now that they are written, those regulations are very comprehensive, and I said that they've been well thought out and they're harmonized. However, they've got limitations. So the DLT sandbox, for example, is just that. It is a sandbox. It is temporary. It will go away. There is market infrastructure regulation being written, but that's not going to finalize until 2030 at the earliest. So that's a bit of a gating factor. Plus, because again, it was a cautious approach by regulators, they implemented things you would expect regulators to implement, like a $500 million limit on equity issuance, or a $500 million limit on UCITS, or a $1 billion issuance limit on bonds, traditional simple debt instruments. And by the way, that's the only things you can issue. So it's much more constrained, and so I think that has slowed innovation relative to the clarity that it's provided. So we keep saying in the U.S. we want clarity, we want clarity, we want clarity. I think this period of experimentation where there was a history which is both emerged in the absence of clear regulation and cultural, there was much more of a tendency to beg forgiveness, not ask permission. And that, I think, really allowed a lot of these things to take hold. So yes, it is great that we now have the Genius Act and we've got more clarity around stablecoins, but I'm kind of glad we had stablecoins in market so we could see how they were used so that we can begin to now think about it. And so there has been a very different approach. I don't know what the right answer is in terms of like one regulator to rule them all, one chain to rule them all. I think that it is important to allow for competition and porousness. So I'm not sure I am as focused on, I am more focused, to be honest, on the problem that Sasha really brought up earlier, which was how do we push this throughout the, how do we, like, what's the e-note equivalent? How do we get people actually utilizing this technology throughout the whole end-to-end life cycle? I think our problems are much more about really finding the killer app, which has yet to occur outside of stablecoin, and less about the regulatory side. That having been said, when I was running blockchain at Amazon, the US was a regulatory no-go zone. Like anything I did, I was launching outside of the US. We were terrified of the US.
Yeah.
And to remove that fear has been spectacular. So I think the opening up of the breathing room is wonderful. I think that's achieved an enormous amount of the benefit. We'll tweak it as we go.
I love that, Mike. And we have so much that we could unpack, even just in the conversation we had, let alone follow-on conversation. So we're just going to have you back as long as you will allow. But as we're wrapping up, one last fun question, and then we'll close out for today since we are up on time. When you think about looking 5 years out, what's something that today is super controversial, but you think in 5 years it's going to be obvious?
Oh, geez. Well, predictions are tough, especially about the future, as Yogi Berra, of course, said. I think
whatever you say, we're putting on Polymarket, by the way. Just
I think there is a lot of how many angels can dance on the head of a pin kind of debate around ownership of an asset and how we translate the difference between control in practice and control in principle. So this really comes to bear in collateral mobility applications where, speaking to Onera about the work they have done, and they said, like, the first year was 80% technical and the second year was 80% legal and regulatory. And a lot of that legal and regulatory is really splitting hairs over, can I pledge this asset? What does it mean that I've given you this asset to hold for security? If things go sideways, how do I know I can repossess that asset? And these are all important things to resolve. But I think a lot of times, my prediction is in 5 years, everybody's going to basically say, yeah, we pushed that one further than we needed to. If you've got control of the asset and you can liquidate it, the fact that somebody's going to come back at me in 6 months in court and challenge that liquidation event is in the level of vanishingly small. We worried about it too much.
We got bigger fish to fry. And on that note, speaking of some bigger fish to fry, this week, trigger legislation, I think, is going into effect. And so naturally, we're going to have Wendy Lee come on next week, and we're going to have a great conversation around consumer data, again, sponsored by Relku. Thank you again so much for that. And thank you, Mike, for being here today. Eric, thank you for co-hosting with Jeremy and I. And we look forward to seeing you all next week on Now Next Later.
Thank you. Appreciate it.
Thanks, Sasha. Thank you, Mike.
Yep.
Thanks.
Bye.